Hello and welcome to Calling Monster Finance. It's September 16th, 2025. Today, the U.S. markets effectively pressed the pause button, closing with minimal changes as a sense of anticipation settled over Wall Street. The major indices hovered near recent highs, but showed a clear lack of directional conviction, ending a session defined more by waiting than by trading. This market-wide inertia stems from a single, dominant factor: the beginning of the Federal Reserve's two-day monetary policy meeting. With a rate decision imminent, investors are holding their positions, awaiting crucial guidance on the future of the economy. Over the next few minutes, we'll break down this pre-Fed holding pattern, analyze the economic data that failed to move the needle, and examine the specific corporate news and commentary that created pockets of volatility in an otherwise quiet market. The main story of today's session was one of suspended animation. After a powerful rally in recent months, the market's momentum came to a halt. The S&P 500, Dow Jones Industrial Average, and Nasdaq Composite all registered modest declines, trading within very tight ranges throughout the day. This wasn't a sign of panic or a major reversal, but rather a collective holding of breath. All eyes are fixed on the Federal Open Market Committee, or FOMC. The market has already priced in a high probability of a 25 basis point interest rate cut. Therefore, the decision itself is not the focus. Instead, investors are intensely focused on the commentary and economic projections that will be released tomorrow. The central question is about the future path of rates. Any signal from the Fed that deviates from the market's dovish expectations could trigger a significant reaction. Today's quiet trading, therefore, can be seen as the calm before a potential storm. This underlying tension was quantified by the CBOE Volatility Index, often called the market's fear gauge. It jumped 4.27% to close at 16.36, signaling a rise in investor anxiety and a reluctance to take on new risk ahead of the Fed's pivotal announcement. The market is a coiled spring, waiting for a clear signal on the pace and depth of the anticipated easing cycle. Diving deeper into the day's key drivers, two factors stand out: the market's reaction to new economic data and the overwhelming influence of the Federal Reserve meeting. First, the August retail sales report was released this morning, and it came in stronger than anticipated. The U.S. Census Bureau reported a 0.6% rise in sales, which was double the consensus forecast of 0.3%. On its face, this suggests the American consumer remains robust and spending is healthy. However, the market's reaction was telling. It largely dismissed the news. Equities did not rally on the strong data, and the major indices remained subdued. This disconnect highlights the market's current mindset. Investors appear to be looking through present economic strength, prioritizing instead their concerns about a potentially slowing jobs market and the belief that preemptive rate cuts are necessary to sustain the economy. The bond market echoed this sentiment. The 10-year Treasury yield, a key benchmark for borrowing costs, barely moved, closing down just 1 basis point at 4.03%. This indicates a strong conviction among traders that the Fed will proceed with rate cuts, regardless of this backward-looking data. This brings us to the second and primary driver: the Fed itself. The FOMC has begun its meeting, and while the outcome tomorrow is what matters, the anticipation shaped every aspect of today's trading. The market has priced in an aggressive easing cycle of approximately 150 basis points over the next year. The critical event will be Fed Chairman Jerome Powell's press conference, where his tone and language will be scrutinized for any hint that the central bank's view differs from this market expectation. The stability in the bond market, combined with the rise in the VIX, perfectly captures this dynamic of a market braced for a potentially significant policy signal. Adding to the day's news flow were notable announcements from two prominent public figures. First, President Donald Trump announced via his Truth Social platform that he has filed a $15 billion defamation lawsuit against the New York Times Company and several of its journalists. The suit alleges libel related to articles published before the 2024 election. While this news did not have a discernible impact on the broader market indices, the report noted it created specific headline risk for the company involved, with its stock reportedly falling between 2 and 2.8% following the announcement. In the corporate world, Tesla CEO Elon Musk made headlines with both his actions and his words. A regulatory filing revealed that Musk had purchased nearly $1 billion worth of Tesla stock. He followed this significant financial commitment with posts on the social media platform X, including one stating, "Daddy is very much home." This was widely interpreted by market participants as a direct response to recent criticism about his divided attention, and a strong signal of his confidence in the company's future. Musk's actions provided a clear catalyst for Tesla's stock, which became a standout performer on an otherwise lackluster day. Shares of Tesla closed higher by 2.82%. This move was also the primary force behind the consumer discretionary sector, which finished as the day's top-performing group within the S&P 500. Turning now to corporate earnings, a couple of key companies reported their latest quarterly results today. First, Dave & Buster's Entertainment delivered disappointing news to its investors. The company reported weaker-than-expected quarterly profits and a 3% decline in same-store sales. This marked a sharp reversal from the more optimistic outlook the company had provided in the previous quarter. The market reaction was swift and negative, with reports indicating that shares plunged by as much as 18% in pre-market trading following the release. Also reporting was Ferguson, a major distributor of plumbing and heating products. The company released its quarterly results, with consensus estimates prior to the announcement pointing toward a slight year-over-year increase in earnings per share. However, the provided market report did not contain further details on the final results or the subsequent market reaction to Ferguson's announcement. Beneath the surface of the flatlining major indices, there was significant divergence among the 11 sectors of the S&P 500. The clear outperformer today was the energy sector, which gained 1.73%. This strength was supported by a notable rise in crude oil prices, with the front-month contract for crude oil climbing 1.84% to settle at $64.18 per barrel. The consumer discretionary sector also had a strong showing, finishing up 0.82%. As mentioned earlier, this performance was largely driven by the 2.82% rally in shares of Tesla, following news of Elon Musk's significant stock purchase. On the other side of the ledger, defensive sectors saw the most weakness. The utility sector was the worst performer of the day, falling sharply by 1.81%. Real estate also underperformed, declining by 0.68%. Notably, the information technology sector, which has been the primary engine of the market's rally this year, also finished in negative territory, down 0.57%. Key mega-cap names like Nvidia and Microsoft were among the decliners, falling 1.61% and 1.23% respectively. This highlights the market's concentration risk and shows how any weakness in this handful of influential stocks can immediately weigh on broader market sentiment. Now let's take a moment to recap the day's closing numbers for the major indices and key indicators. For the major U.S. indices, the Dow Jones Industrial Average fell 125.55 points, or 0.27%, to close at 45,757.9. The S&P 500 index declined 8.52 points, or 0.13%, to finish at 6,606.76. The Nasdaq Composite slipped 14.79 points, or 0.07%, ending the day at 22,333.96. And the Russell 2000 index of small-cap stocks was down 2.1 points, or 0.09%, to close at 2,403.03. Looking at other key market indicators, the CBOE Volatility Index rose 4.27% to 16.36. The US dollar index fell 0.65% to 96.67. The yield on the 10-year Treasury note was little changed, down slightly to 4.03%. In commodities, crude oil gained 1.84% to $64.18 a barrel. Gold added 0.23% to finish at $3,727.70 an ounce, and Bitcoin saw a gain of 1.35%, trading at $116,919.33. Now for today's most actively traded stocks by turnover. Here are the top 5 companies. Number 1 was Tesla, which closed up 2.82%. Number 2 was Nvidia, which finished down 1.61%. Third was Oracle, which gained 1.49%. Fourth was Apple, closing higher by 0.61%. And the fifth most active company was Microsoft, which ended the day down 1.23%. In summary, today's market session was a clear story of a market on pause. With minimal movement in the major indices, but a notable rise in the volatility index, investors signaled their apprehension and intense focus on the Federal Reserve. Strong retail sales data was overlooked, reinforcing the narrative that monetary policy is the only story that matters right now. Looking ahead, the single most important variable for tomorrow's session will be the tone and content of Fed Chairman Jerome Powell's press conference. His guidance on the future path of interest rates will determine whether the market's dovish expectations are validated or challenged, likely setting the direction for trading in the days and weeks to come. If you found this analysis helpful, please hit the like button, subscribe to our channel, and share this video with your friends. The content provided on this channel is for informational and educational purposes only and does not constitute financial, investment, or legal advice. All investment decisions should be made with independent due diligence and in consultation with a qualified professional. While we strive to ensure the accuracy of the information presented, we cannot guarantee its completeness or correctness. Any risks or losses resulting from the information on this channel are solely the responsibility of the individual. The views and opinions expressed in this video are those of the speakers and do not necessarily reflect the official policy or position of this channel. This content is not an offer or solicitation to buy or sell any financial instruments.